Greetings. In this video, we're going to go over the yield curve and what it is, and we're also going to talk about inversion of the yield curve and why it's important for us as investors, crypto investors. No matter what you do with your assets, it's important to have this concept. It's important to understand this. This is the yield curve generally. This is over time. What we're talking about here is debt instruments for periods of time. So you can have a debt instrument for 6 months, you can have a debt instrument for 5 years, you can have a debt instrument for 30 years. In the short run, when we have debt instruments that are in a shorter time period, they should be a lower annualized rate than in the long run. Annualized rate just being the interest rate that you would be getting paid out. So in the short run, we see lower rates. In the long run, we see longer rates. And the curve looks like this, generally speaking. This could make intuitive sense because why would we expect lower interest rate in the short run than in the long run? Well, we're less likely to get our money back in the short run than in the long run. Makes perfect sense. It's completely intuitive if you really give it time and you really think about it. It's completely intuitive that the curve would show that all things being equal, that we would expect less money in the short run and more money in the long run, and it would look something like this. And it is market determined, so it's not something set by the Fed or whatever. This is something market determined by the free market, and so we see the interest rates going, like from showing more risk or less risk in the short run and more risk in the long run. So this is why the yield curve typically looks like this. Now, inversion yield curve, what is that? That is when you're getting higher analyzed rates in the short run than in the long run. So that's basically the market saying that there's more risk in the short run. There's more risk to give someone some kind of loan in the short run than in the long run. That means that there's something unhealthy about the markets. There's something unhealthy about the average person that would be taking a loan. There's unhealthiness in the market in the short run. That's why the inverted yield curve is so important. And in fact, the reason I'm covering this concept is because we're in an inverted yield curve environment right now at the making of this video. You could see that in 21 it was a normal yield curve. It flattened in 22, roughly speaking, and we are in fact seeing higher interest rates in the short run than in the long run. Right now, an inverted yield curve saying that there is very much a recession on the horizon. And this is how reliable it is. You could look at the difference between the yield curves right here. You can see when it's under zero, there's a negative rate. The long term is under the short term. It's supposed to be positive, right? And you can see most of the time the yield curve is normal, but in periods right before a recession, right before a significant stock pullback, we can see that the yield curve inverts, and you can see it by these dots. Now, sometimes it doesn't determine it, but it's extremely rare. You can see most of the time it's a very reliable metric, and even I would even count the ones that just come and graze it. So you could say it's about 90 to 80% chance that the yield curve is going, or that the yield curve predicts a recession. It's pretty accurate. It's like one of the most reliable metrics. And we're usually talking about what is recession. It's typically a 40 to 65% pullback of the stock market. Okay, so now that you guys get this concept, you can look here at we're about to describe why this is important for crypto. So this is in fact, where we are right now. We're in significant negative yield curve territory, and we're looking at the crypto market, and we want to know how it's going to affect it. Well, this goes back to 1980. Crypto is only, we're talking about altcoins because we want the 1000x returns, right? That's what we all want for crypto. Well, crypto's really only been around the altcoins since 2015, so they're extremely young. You could even see that it's never been around a recession at all. These maybe this little one with COVID, but there's been no significant recession yet. So how will it affect crypto? That's the big question. And, you know, like we could say things for sure, like we know that there's a recession right here coming because of the inversion of the yield curve. We could say there's an 80 to 90% chance that there's a recession, 40 to 65% pullback. So we know that we don't want to buy houses, and we know that we don't want to buy the traditional stock market because this reliable metric is telling us, hey, there's a pretty strong chance there's a recession. So you don't want to buy houses, you don't want to buy the traditional stock market. But I am going to say that there are some things that do not get affected by the recession. That would be tech stocks. You know, it could be tech stocks. But I think it might be crypto might be in that environment. Why? Because crypto is so tiny. Crypto, in my opinion, has a 99% chance, and this some people might think this is crazy. I'm actually going to write this. So I think that there's a 99% chance that crypto is going to 400x, the altcoin market cap is going to 400x over 10 years. So why do I say that? It's because of my understanding of the space and my understanding of the technology. I would say that now picking the right ones is very hard, but in my opinion, there's like a 99% chance that we're going to 400x over 10 years. And so it's one of the most assured ways to get financially independent, get financially wealthy. And the reason I say that is because of my experience in the space. But in the short run, how do you think a recession is going to affect this tiny little market? It could affect it significantly. It could not. I don't play those games. In my opinion, this is such a small market, and I know that there's a significant chance that this market is going to do wild things, specifically the altcoins, the smaller market cap altcoins. So in my opinion, it's better just to hold for the long term, dollar cost average, and do those things and play the long game. But this is the reason to go the yield curve, because we want to know how it's going to affect in the short run. And if you're on the conservative side, you might want to wait. Because we are in a significant recession prediction territory. So we're very likely to see a recession in this little slot. So you can hold dollars and you can wait and see how you think it's going to affect the space. It's entirely possible that crypto gets impacted from the stock market pullback that is likely to happen. All right, later, guys.